You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, Jonathan McEwen, and my co-host Sam Ball. This week on The Investor Way, we have SSE, BHP Billiton, Royal Mail, easyJet, Beazley, and our US company of the week is Coca-Cola. Sam, do you want to kick off with SSE?
Yes. So SSE, who, for anyone who don't know, are the utility company. They've released a trading statement ahead of their AGM, and they've said that total renewables output has fallen to 1,674 gigawatts in the 3 months to 30 June 2021, down from 1,962 gigawatts last year. And that's well below the target of 2,077 gigawatts, and that reflects unfavourable weather conditions. Gas output fell 9% year over year to 3,751 gigawatts, which the group puts down to plant availability and market conditions. Electricity distribution rose 13% to 8.7 terawatts. The group continues to make substantial investment in its renewable and transmission business, with planned capital expenditure this financial year of around 2 billion. That will be funded in part by the disposal of non-core assets, with SSE completing the sale of its contracting business at the end of June and planning to sell its UK gas network by the end of the calendar year. SSE has reported a 1% increase in full-year operating profit to 1.5 billion, and that's after COVID reduced operating profits by 170 million, which is at the lower end of the guidance range. Underlying earnings per share rose 5% to 87.5p. SSE is not providing detailed guidance for next year, but expects the enterprise and business energy divisions to incur the bulk of the ongoing coronavirus costs. Underlying profit at the networks division fell 15% to 488.2 million. Operating profit at the SSE and distribution fell 25% to 267.3 million, primarily reflecting lower volumes from non-households. Underlying operating profit at the renewables division rose from 567.3 million to 731.8 million. This included 226 million from the sale of 51% of the Seagreen offshore wind farm and 10% of the Dogger Bank farms. Excluding this contribution, operating profit fell due to a 10% decrease in output from disposals and adverse weather, partially offset by higher prices and plant availability. Thermal generation reported a 5% increase in underlying operating profit to 160.5 million. Higher utilisation and asset sales entirely offset the impact of a one-off restatement in the prior year. Adjusted net debt and hybrid capital fell from 10.5 billion to 8.9 billion, reflecting ongoing asset sales and adjustments, partially offset by ongoing investment. Net debt is now 4.6 times cash profits, within the group's 4.5 to 5 target range. In terms of the valuation, the company trades at a PE of about 17 and has a prospective dividend yield over the next 12 months of 5.6%.
What do you think about that in terms of valuation? Because price to earnings of 17 for a utility company sort of stands out as quite high.
I think the dividend yield is probably the most important anyway, because it's an income play. But that'll be, I think, because it's a trading statement. So where I've got the PE from, it's not been updated to reflect those results.
I see, okay.
I've not bothered working it out just because it is really the dividend yield that's probably more important.
Yeah.
There are a couple of other interesting things. So they're now operating through two main divisions, which is the networks division that delivers electricity to homes and the renewable energy division. And renewables made up 49% of operating profits last year, but the plan is to treble output by 2030 to 30 terawatt hours a year, which is enough to power Scotland. What are your thoughts then on these results and the company?
I don't know. I'd be slightly concerned about the renewables in the sense that you see how weather can impact on them. I suppose as an industry, I think that the fact that there's so much regulation is a bit off-putting, and you've got the in the UK, or certainly in England, you've got the energy price cap that the government introduced a few years ago. I think that would be a worry, especially when you're investing a lot of money in terms of like capital expenditure on renewables. But I don't know. I probably would be a bit wary of it. I think if I were looking for an income play, there would be things that might be potentially less regulated and have arguably equally reliable income streams. It's got I suppose, a fair bit of debt, although I guess the revenue is, should be, as a utility company, fairly reliable. It certainly looks healthier than Centrica, which we've covered, we've covered on the show before, but it's probably one that I wouldn't be looking at in too much more detail at the moment, really. What are your thoughts?
I don't like it. I think the debt is at the very, very top of what I'd consider a manageable level. And the fact that the dividend's so high, debt really, I think that debt could actually impact the ability to pay the dividend at some point. And if they want to treble renewables, that's going to be a lot of capital expenditure that's needed. So I don't see the debt going down anytime soon. So I just think, if the yield's that high, that to me suggests that the market thinks it might be unsustainable. And I think they're probably right. Yeah.
And I suppose, if you've got the scrip dividend going as well, that's making it easier for them to pay it, but it's obviously not sustainable.
It's the debt, really. I think I'd probably like it more if they actually just came out and cut the dividend and said, well, we want renewables to be driving the business going forward, and we've got to invest in that. I don't really like the fact that they're just trying to carry on the dividend and just piling it up with debt.
I mean, I suppose you might see a short-term fall in the share price if they do that on the basis that that's what people are buying it for. But it could make the business healthier. And you've seen the big players, obviously not just sort of utility, but sort of energy companies like your BPs and your Shells cutting the dividend.
Yeah, and I think as well, like the last 18 months was probably a really good opportunity to cut the dividend without getting the normal adverse reaction that you'd expect.
Yeah, that's right. Everything COVID and
they could have cut the dividend and got away with it. Whereas, like you say, if they do it now, it's not going to be looked on favourably by the market.
Yeah, but no, I don't think one for me, and by the sounds of it, not for you either.
No.
Okay, so on to BHP, which is UK listed on FTSE 100, and it's the world's largest miner. They had their half-year results out this week, and half-year profits came in at $3.9 billion compared with $4.9 billion last year. And the decline reflects non-cash charges relating to the reduction in the value of the coal assets, as well as the costs associated with COVID and the Samarco dam failure. Excluding these items, on an underlying basis, BHP actually made a $6 billion profit compared with $5.2 billion last year. And that was thanks to the increase in commodity prices, which we'll go on to discuss. In terms of their copper division, or I suppose copper price, but copper division, cash profits rose from $1.4 billion to $3.7 billion as a result of the higher copper prices. And if we actually look at the unit costs from Escondia, which is BHP's largest mine, the unit costs fell by 18% to so 90 cents essentially per pound of copper. And full year guidance for the unit costs of copper is between $1 and $1.25. And the current copper price is currently $4.34 a pound. In terms of iron ore, cash profits rose from $3.1 billion to $10.2 billion, again reflective of the higher prices combined with record production at the Western Australia iron ore mine. Unit costs in iron ore rose 10% to $14.38 per tonne, with the expectation of them being between $13 and $14 for the full year. And spot price for iron ore at time of recording was $214. In coal, there was actually a loss of $201 million compared with an $898 million profit last year, which was down to lower prices, lower volumes, and unit costs rising by 20% in Queensland. All of this resulted in $5.2 billion in free cash flow after capital expenditure of $3.6 billion and a 7% reduction in net debt down to $11.8 billion. Currently, BHP has a market cap of just over $114 billion. Its prospective dividend yield is nearly 6%, and the group targets paying 50% of their earnings as a dividend. In terms of price to earnings, it's currently around the 17 mark. Sam, what do you think of BHP?
I mean, they're very good results. You'd expect very good results given what's happened to the prices of the commodities. I mean, there's a little table where they've given the prices for the June 21 half versus the June 20, and the average price for oil is 68% higher, natural gas 29% higher, copper 82%, iron ore 106%, nickel 41%, and then obviously that's taking like the best comparison. But even if you compare full year 21 versus full year 20, oil's up 6%, natural gas 8%, copper 52%, iron ore 69%, and nickel 17%. So they've got a big boost from that. I'd say a PE of 17 is quite expensive for such a cyclical business at what could be the top of the cycle. I know if we go into a more inflationary environment, it's the sort of thing you'd want to hold. But if we don't get an inflationary environment, it looks quite expensive to me.
Yeah, I would probably have, maybe been a little bit more bullish on it. I don't think it's at 17 in the current environment, it is all that expensive. But yeah, I think if you were to buy the company, or any miner, you'd expect volatility. And I think certainly it's in a much healthier state than it was, I guess, back in 2008. And they've got, I think, a more sustainable dividend policy going forward. I've held it in the past. I probably regret selling it. I had it, I think, back in 2017 when it was about £8, or 2016 when it was about £8 a share. I sold it for about £13.50, and
what is it today?
I think it's about 22. And I'd have got a dividend through those years as well. But I have a commodities index in the portfolio for the exposure to this. But of course, the commodities themselves don't pay you a dividend like BHP does, especially when it's, in the current state and doing well. But with all of the miners, you're going to expect it to be cyclical. And if you're not prepared for that sort of volatility, maybe you wouldn't be comfortable holding it, or you'd hold it as part of an index maybe. But I guess it probably does depend on where you see the commodity prices going in the short term. If you were buying shares, I mean, we'd obviously say buy for the long term. And I know you've pointed out that you think 17, where you think we might be in the cycle, is relatively high.
Yeah, I just think with something like that, it's probably I don't know where we are in the cycle, but we're more likely to be towards the top than the bottom. I think the time to buy it is probably, in a situation like you did, where it's much closer to the bottom of the cycle.
Yeah. No, that's fair enough. And if you were to ask me, would I be buying it now? I guess I've got that sort of psychological hangover from when I owned it before, and I knew what I paid for it then. But obviously things were much more torrid for the company at the time, and the prices aren't what they are now, and the company is in a much healthier state, so you're not buying the same thing, and that shouldn't now influence me as to whether I buy it at the current price. But yeah, I do hear what you're saying. But if you were to compare it with something else, let's say the S&P 500, you'd have probably said for, I don't know, the last 5 years that you think we're at the top of the cycle, things are overvalued, and then 5 years later you find that the S&P it's doubled or more than doubled. So it is very difficult to predict where we are in the cycle. But regardless, if you were to buy it, you should be buying it for the long term. But it's debatable, I think, as to whether at the price to earnings of 17 it's expensive or not, where given where we are and given what the prices are as well. And I mean, you see, what did I say earlier? Copper is currently costing them less than $1 per pound to produce, and the current price is over $4. And yeah, I mean, it's ginormous. And again, if you look at iron ore per unit, they're looking at $13 to $14 a ton, and that's selling for over $200.
It's not bad.
It's not bad. It's not bad. So it's certainly, yeah, I'd certainly rather buy BHP at the current price than SSE.
Yeah, I'd agree with you there.
But I mean, that's I appreciate that. That's yeah. We're not comparing everything we consider investing with SSE, and that doesn't necessarily make the case for investment. But yeah, okay. So is it one that you'll watch, or I mean, what do you think in terms of exposure to commodities? And would you buy a company or would you buy an index?
I'd say where my portfolio is at the minute and how like early on I am as an investor, I'd be more likely to buy a company. I think later on with a larger portfolio, I'd be more inclined to buy like a tracker fund for it. But it's just because I guess with a company, it's going to be more volatile, but you could probably do better.
Yeah, yeah. And you'd see that with I think that's true. And I wouldn't be, I'm definitely, well, I've got a commodities index as part of the portfolio, which is not doing, obviously, I was going to say not doing badly, it's doing very well with commodity prices increasing. But I think you do get, in the long term, you get a better return with a decent mining company.
Yeah.
So it may be one that I look at, whether I buy now or whether I buy in the future, but just need to get over that psychological hurdle.
I'll just pick a different miner.
Or I'll pick a different miner. Well, I nearly, at the time, I nearly bought Rio Tinto as well. But anyway, we won't go down that path. Okay, onto, well, perhaps a less healthy company, Royal Mail, Sam.
Yes, so Royal Mail have come out with a trading statement, and they've reported first quarter revenue growth of 12.5% compared to a year ago. And that's up 20.2% compared to 2019. That reflects growth across both the Royal Mail and GLS divisions, with GLS being the delivery, like the parcel delivery side, despite a slowdown in UK parcels. The outlook for the group remains uncertain and will depend on the future course of the pandemic. As things stand, the group expects revenue growth at GLS to slow as the year progresses, as lockdown restrictions ease across its footprint and the division laps stronger comparators. Royal Mail reported 12.2% growth year on year and a 13.4% increase compared to 2019. That reflects a rebasing in parcel volumes, which are down 13% year on year, but still 19% ahead of pre-pandemic levels. Despite lower volumes, parcel revenues grew 3.4% year on year as customers shifted towards higher priced products. Addressed letter volumes rose 22% year on year, although the long-term decline continued with an 18% fall from pre-pandemic levels. Total letter revenues rose 25.7% year on year. The GLS international business reported 12.4% revenue growth year on year and 36.6% growth compared to the pre-pandemic. Volumes increased 10 and 34% respectively. As well as higher volumes, the group benefited from improved prices and higher freight rates, boosted by the reopening of retail outlets. In terms of valuation, the company trades at a PE ratio of 9.2, and that compares to an average ratio since listing of 12.6. And it has a prospective dividend yield in the next 12 months at 3.9%. So I've mentioned investment in parcels infrastructure is set to rise with capital expenditure, expected to be well over 400 million next year in the UK alone. And construction of a new fully automated parcels hub in the Midlands is underway, which will be capable of sorting over 1 million parcels a day by 2023. And at the moment, only 33% of UK parcels are sorted by machine versus an industry benchmark of 90%. And it's worth mentioning as well, these are very good results. My issue is the long-term decline of the letters side of the business. We had a similar thing when we looked at Deutsche Post a few months ago. Now, Deutsche Post, or just for some comparison, they don't actually split it out. You have to go in and find it a bit, really. But if you go into the 1920 results, parcels made up 47.9% of UK PIL revenue and letters 52.1%. Total group revenue was 10.44 billion. So using that, I worked out the letters make up 37% of the overall revenue, which is much higher than Deutsche Post's figure. I only had a quick look, so I couldn't find the exact figure, but Deutsche Post's domestic post and parcels business is only 33% of revenue. So it's going to be even smaller than that. I don't, as a guess, I'd maybe say 15 to 20% for Deutsche Post. And Deutsche Post is actually declining slower. So Deutsche Post is declining slower as well. So it was down 4% last year. And that compared to pre-pandemic levels, Royal Mail's down 18%. So it is cheaper than Deutsche Post at 9.2. I've not looked at it since we last covered it, but Deutsche Post was at a PE of about 15. I'd rather pay up for Deutsche Post. And as well as the letters business, I mean, Deutsche Post DHL side is just a much stronger business as well. So with that slightly leading monologue, what are your thoughts on this trading statement and Royal Mail?
I thought the results were quite good. Would have some reservations about Royal Mail as a company, and I suppose it's very highly unionized, which I think if you're an investor is probably something that's quite concerning. It also, with the letters business, it does have the universal delivery obligation as well, so it can't, it's not easy to cut off places that really are not profitable. That's something else. So I think there are two things. We didn't talk about it, but it does have quite a large pension deficit, I believe. I haven't looked at it recently. That might be something that we could revisit. And I suppose there is that natural decline in letters, and how dependent are Royal Mail on that, and can they replace it with the growth of the parcels division? And like you say, I mean, just mentioning Deutsche Post, it's a very competitive area in the market for parcels. And I appreciate Royal Mail have been sort of doing relatively well out of it, but will they be able to continue that going forward, especially with such a unionized workforce, when its competitors don't have those, I suppose, those issues in making themselves potentially more competitive? The other thing I'd point out is that perhaps if you looked at it at various points, probably in the last couple of years, it's potentially been more undervalued. I think the fact that it's had these good results and the numbers have been making the case for investment. It's, in the last year, it's up nearly 3 times, which I don't know how much value there is to be had when you've got potentially better competitors, which would have, I would think, like you've just outlined, a stronger investment case.
Would you, in fact, I'll just check the Deutsche Post PE. Yahoo Finance have it at a PE of 19 now. Quite expensive. It looks like it's had a nice little run since we covered it.
Influence the market.
Yeah, we'll have to watch that in the future. But so it's actually now at 19. So that does change it slightly, because Deutsche Post is definitely more expensive. My view is I'd still rather pay 19 for Deutsche Post than 9 for Royal Mail. What about you?
I would say so. I think Royal Mail would have to be cheaper still for me to be interested. And I don't particularly like it as a company, so I wouldn't be investing in it myself.
Yeah. Okay. Should we move on to another company you probably won't be investing in then?
Okay. Well, it's easyJet, the FTSE 100 low-cost airline. They had a quarterly trading update out this week, with the group reporting a pre-tax loss of £318 million in the 3 months to June the 30th, which is actually an improvement on the £346.8 million loss in the same period last year. Revenue of £212.9 million was up from £7.2 million in 2020, reflecting an increase in both passengers and ancillary revenue of £61 million. There was an increase in the per passenger spend on extras like extra baggage allowance and premium seating options. The resumption in some flights led to a rise in headline costs to £531.2 million from the £354 million in 2020. And the group also paid £122 billion in refunds to customers. The total cost of the pandemic refunds now stands at £1.2 billion for easyJet and the group flew 3 million passengers during the period with a capacity of 4.5 million, which, if you compare it with 2019, is only 17%. And even taking that into account, with the reduced capacity, only 49% of the group's schedules had actually been booked, compared with 65% of a much larger capacity in 2019. However, easyJet do note that customers are booking closer to the departure dates than previously, with a changing of restrictions. So almost hopefully the numbers won't be quite as bad as they seem going forward. But I think I'm yet to be convinced on that. easyJet have now reduced their fleet by 10% over the course of the pandemic, and their cost-saving program is expected to deliver £500 million of savings, half of which are thought to be sustainable when conditions return to normal. Going forward, the group will be taking delivery of new, more efficient aircraft from the autumn, growing their fleet to 317 by 2022. As it stands, easyJet have access to 2.9 billion in cash and loans, and will have to pay back 300 million pounds in government loans by November, but remaining repayments come in 2023. Total cash burn during the quarter was 55 million pounds, with capital expenditure and fixed costs coming in at 34 million pounds per week on average, which that's actually slightly less than the market was expecting, 40 million pounds, but I mean, it's not great. In terms of the valuation, the price to book stands at 1.8 compared with a 10-year average of 2.16. In terms of its market cap, it's currently 3.7 billion pounds. Sam, easyJet, what do you think of these numbers? Are they as bad as they seem?
I mean, they're pretty bad. I mean, to be honest, it doesn't really matter to me, if they're increasing or not. It's just not a business I'd want to touch at the moment. I don't think the numbers would have had to be really outstanding for me to really be interested. It's not an industry I particularly like. Pre-pandemic, I don't understand why anyone would want to own it. What about you?
Yeah, I really do struggle to find any sort of investment case for easyJet. I mean, maybe you could have had, speculated a little bit, immediately after COVID and said, oh, well, is it undervalued or could it rebound? But I mean, I think it would be really pure speculation on that front. And yeah, it's not, I wasn't interested pre-pandemic. I'm not interested now. I mean, hopefully for easyJet, they will recover, but I think there are so many question marks over it. And I think the group would probably have hoped that this summer there'd have been more freedom in terms of the travel, but with rules changing all the time and the uncertainty about tests, COVID passports, everything, I can't imagine the rest of the year's results are going to be all that good. And especially given that summer is the season where they make most of the money, I wouldn't be all that optimistic.
I don't think it was like that attractive a business before the pandemic either. So considering that how much risk is baked into them just getting back to where they were, it wasn't a great business to start with. No, so I just don't know why you'd want to sign yourself up for that ride.
No. I would agree with you there. And I think if we do compare it pre-pandemic, shares were about around the £15 mark, and they're now £8. They did drop as low as sort of £4, but yeah, it's not what I'm interested in. And by the sounds of it, you're not either. I don't Definitely think it's not making the watch list.
No.
Don't think it would have done before, but it's certainly not now. Okay. Any more to be said?
I don't think so. We could criticize it a bit more, but what?
No. It's having a torrid enough time already. Beazley Group.
Yeah, so Beazley Group, for anyone who doesn't know, they are a FTSE 250 listed insurer. So I'll just read quickly from their website. Beazley is a proud participant in the Lloyd's market, the largest and oldest insurance market in the world. Through the Lloyd's broker network and the market's trading licenses, we are able to access a wide range of insurance and reinsurance businesses from around the world. Our client base is broadly diversified by type, by size, and by geography. Our clients are leaders in many of the markets in which they operate. Over 3 decades, Beazley has evolved from a specialist Lloyd's syndicate transacting business exclusively from the Beazley box in Lloyd's in London to a global insurer with offices in Europe, Asia, and across North America. So they have come out with their half-year results to 30 June 2021, and they have returned to profit, delivering 22% revenue growth. So they report all their figures in dollars, and they've announced profit before tax of 167.3 million, and that compared with a loss of 13.8 million for the half last year. Return on equity of 15%, and that compared with a loss of 1% last year. Global premiums written increased by 22% to 2.035 billion, and that increased from 1.664 billion last year. They've announced prior year reserves releases of 95.7 million, and that compares to 58.6 million a year ago. They've announced net investment income of 83.6 million, and that compares to 83.2 million a year ago. And there will not be a dividend, and there was also not a dividend last year. Adrian Cox, the CEO, has said Beazley's gross premiums written increased by 22% to 2.035 billion, with all divisions achieving rate rises in the first 6 months of 2021. Reserve releases across all divisions supported a half-year combined ratio of 94%, and the investment return achieved was also strong at 1.2% year to date. I'm excited about the growth opportunities ahead. Our capital base remains strong, and we are well placed to support an ambitious growth plan at similar levels to 2021. The board remains committed to a dividend payment and will consider this at year end after taking into account the 2021 results as a whole. Interestingly, so the valuation's not really that helpful because they don't have a PE ratio, because these are only for the 6-month results, and for the year last year they had a loss. If you were to take the 2019 earnings and treat that as normalized earnings, you'd get a PE ratio of 11. However, because they are an insurer, the historic earnings per share have been very lumpy. So just to go through them, 2016 to 2020 inclusive, 48.6 cents a share, 25 cents a share, 13 cents a share, 44.6 cents a share, and an 8 cents a share loss. So I'd be very, very hesitant before I used that as a normalized PE ratio. I don't know if you possibly be better taking an average of the 5 years maybe instead. If you look at the revenue growth, which is maybe a better metric of how the business is doing, revenue increased from 2.195 billion in 2016 to 3.563 billion in 2020. However, my reservation with that is the thing with being an insurer is you can write insurance at any price. So you can almost increase your revenue by will if you want. And that doesn't necessarily mean that you're writing good insurance. I've seen nothing to suggest this is a bad company, but for me, it just goes in the too hard pile. I just find it too difficult to value, to be honest.
It'd be interesting to compare it, perhaps even, on the 2020 year with other insurers to see how it, in terms of the loss that it suffered, how big that loss was, and whether that's, like you say, reflective of different policies that have been written. I think it's difficult to understand. It sounds like it's probably not too expensive at the moment, but it is difficult to analyze, really. So I'd probably be in the same boat with you there, Sam.
It reminds me of something Adam Mead said in his interview. He's talking about banking, but he said, anyone can loan money. The key is to get it back. And it's quite similar in insurance, where anyone can write insurance. But it doesn't mean you'll have written it profitably.
Exactly. You need to have good management and good actuaries to do it.
And it's just not really within my circle of competence to be analysing insurers, to be honest.
No, fair enough.
Still, they look like good results on the surface, at least. Anyway.
And the shares responded well as well. So okay, on to a business that is easier to understand, and that is our US company of the week, Coca-Cola. They have their second quarter trading update, and in fact, I'll just give a bit of background to Coca-Cola. So obviously, they have the famous Coke brands. They do have number of other drinks in the portfolio. So if we look beyond Coke, they also own Dr. Pepper, Sprite, Fanta, Lilt, Smart Water, Vitamin Water, Oasis, the Schweppes portfolio, Appletiser, Innocent Smoothies, Powerade, Aquarius, Fuse Tea, and Costa Coffee. So that's just, we're talking about Coke, but that's the portfolio that they own. So yeah, their second quarter trading update, organic revenue rose 37% to $10.1 billion, with a 26% increase in concentrate sales and an 11% increase due to increased pricing and product mix, resulting in a 46% increase in underlying profits to $3 billion. And if we break those results down further, in Europe, the Middle East, and the Africa division, that saw revenue rise by 61% to $2 billion, with particular growth in Russia, Spain, Germany, Nigeria, Turkey, and Pakistan. Operating profits were up 56% to $1.1 billion, with a 21% growth in volumes, favorable pricing, product mix, and timing of the concentrate sales. In Latin America, revenue was up 39% to $1.1 billion, with profits up from $504 million to $678 million, with strong growth in Brazil and Mexico, particularly of the sparkling soft drinks and hydration drinks. In North America, revenue rose 28% to $3.4 billion, with profits up 47% to $950 million, with away from home sales rebounding and the recovery of the fountain drinks, so sort of drinks from dispensers also. In Asia Pacific, revenue was up 21% to $1.5 billion, and profits came in at $766 million, which was a 10% rise. In the Global Ventures division, which includes Costa Coffee retail stores, reported a revenue of $707 million and brought in a profit of $75 million, compared with a $102 million loss in 2020 when things were closed. In Bottling Investments division, they reported a 29% increase in revenue to $1.7 billion, with growth in India and South Africa. Profits came in at $92 million compared with $12 million the previous year. And overall net debt for Coca-Cola stood at $30.7 billion, which was down from $34.2 billion at the start of last year, which works out at roughly 2.7 times 2020 cash profits. Free cash flow was $5.1 billion, which is an increase of $2.8 billion compared with 2020. In terms of valuation, Coke has a market cap of around $240 billion. Price to earnings is currently around 24.4, 10-year average of 20.8, and the prospective dividend yield is around 3%. And over the past 5 years, Coke has returned over 30% in share price growth, and that's excluding dividends. Sam, what do you think of these results in Coke as a company?
I think they're very good results. I think, interestingly, they probably bode very well for Coca-Cola HBC, which we've looked at before. They've said that Nigeria grew, and that's one of the areas operated by Coca-Cola HBC, I think.
Mm-hmm. Mm-hmm. Yeah, it is.
So it'll be interesting to see if that comes through in their results as well, which I'd expect it would. In terms of Coke, I think they're fantastic results. They are really, really impressive figures. I really like the company. I am not too concerned. So the debt's actually only 2.7 2020 cash profits. So it's not really that high, I don't think. I think they can more than afford to pay that. My only issue is at a PE of 24.4. We looked at Pepsi last week, and that was only a PE of 23. As much as I like Coke and the business, I don't know why you wouldn't choose Pepsi over Coke when the PE is lower, and I think you're probably getting a more diversified investment because of the snacks.
Yeah.
What about
you? I like Coke as a company. I mean, I think it's got some incredible brands, and the profit margins are huge. They're, I think, around 60%, sometimes higher. But yeah, it's certainly not cheap as a company to buy. But I guess when you've got a company this high quality, it's never going to be cheap. In terms of the comparison with Pepsi, yeah, I think Pepsi, it's got twice the revenues of Coke, and it's probably more attractive because it's got sort of that diversity and it's got the snacks business. Pepsi, probably not as strong a brand as Coke, and it's, is it always second to Coke? But because it's got that diversity, it probably would be the company that I prefer as an investment. But I like them both, and I'd be tempted to pay up for that quality of company. You've got other consumer companies, which I have in my own portfolio, like Unilever and Reckitt, but I think, and Kraft Heinz for that matter. But I think probably Coke and Pepsi are at least on the same level, probably higher in terms of the quality of the brands that they have. You might say that Coke is the world's strongest brand. So yeah, it's a great company. I probably wouldn't have a problem buying either Coke or Pepsi, but if it were between the two, probably go for Pepsi.
Yeah. Would you? So you could have Coke at 24 times earnings. Would you prefer that or Coca-Cola HBC? Coca-Cola HBC currently trades at 27 times earnings, but the half-year results don't come out until 12th of August. And based on this, it looks like they're going to be very, very good.
Yeah, which would I rather? I think I probably would go for Coke, and it would be a buy and forget stock.
Coca-Cola HBC.
HBC, okay.
Because you're still getting Coke. You just get those countries where you potentially
get
growth's going to come from.
You're getting, yeah.
Still the Coke brand.
Yeah.
And what you are paying up for really is the brand.
Yeah.
So I'd go for HBC.
Yeah. And it's more expensive. It is anticipating that higher growth in those markets.
Yeah, but based on the results, it's going to get it.
It's going to, it is. Yeah. Well, we look forward to covering those results when they do come out.
So of the 6 companies then that we've covered this week, SSE, BHP, Royal Mail, easyJet, Beazley, Coca-Cola. If you had to buy one, which one would it be?
On the basis of buying it and holding it forever, I'd probably go for Coca-Cola. And I wouldn't have any sleepless nights, which if I were to look at the second company, it would probably be BHP, and you'd be prepared for a bumpier ride, I think.
Yeah, I'd go for Coca-Cola as well for that reason.
Okay. Well,
pretty boring.
I'd
go if Coca-Cola HBC was the option, one of the options. I'd go for that instead.
Fair enough. You pay up a bit more for that higher growth.
Yeah, but that PE will come down as soon as those results come out.
Yeah. We'll watch this space. Well, we've got, it looks like a bumper week next week. So we'll probably divide it over 2. But thank you for listening this week. And we'll see you again next week for some of the big hitters from the FTSE 100.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.